Hello everyone! If you wonder what trading instrument is better for you, let me show you the most important pros and cons of both futures and options with some real-life examples. In this video, we are only considering factors important for a day trader, not any longer-term trading or hedging activities. Let's get started. First question you might have: what is more risky, trading options or futures? Many traders get it wrong. They think that futures are more risky because you have paid more money upfront for the contract. And when a big move occurs, you can lose much more because when you buy an option, you can only lose the premium you have paid, which is far less than the price of a futures contract. But this is not the way how you should think about it. Let's dive a bit deeper. In this example, we are trying to catch a smaller move in a choppy session, so it is not an A+ setup. But it will show us some important aspects we need to consider. Let's say we went short at 69.25.5 at the rejection of the point of control, and our exit was at 69.19.5. It's negative first standard deviation of the daily VWAP. The stop loss was at 69.27.5. So it is a 6-point move with 2 points of risks when we exclude any commissions. You have sold one ES contract. Your stop loss would be worth $100 for $300 of possible profit. If you have bought one SPX 0DTE put option with 50 delta, you would achieve the same risk profile. Stop loss about $100, profit also around $300. This trade took about 5 minutes, so we don't need to worry about theta decay. So what's the difference? First of all, margin requirements. If your broker allows 30x leverage on futures, your margin requirements would be around $23,000. The SPX put contract was worth only $700 in this low IV environment, so you would only need $700 of margin requirements. That's a huge difference, but it doesn't make this trade more risky when you trade futures. It is still about 1 to 3 risk to reward in both cases. And yes, you might argue, what if the market moves suddenly right after we enter? Let's say 30 points higher, and the stop doesn't trigger for some reason. For example, there is a big sudden news, and the market makes that move in seconds. In that case, the SPX put contract would be probably worth less than $100. So you would lose about $600, and the maximal loss would be $700. Futures, your loss would be $1,500. So this is the argument many traders make. But how often does it really happen? The probability is very low. Slippage is a very important topic for a day trader. There are 2 categories. Bad fill occurs when an order is filled at a different price than originally intended by the trader. This can happen for several reasons, as market volatility or rapid price movements. This is why I recommend to enter a trade through a limit order with some offset rather than sending market orders. This kind of slippage has also influence on our stop loss orders, which is a very frequent hidden cost of trading and should be calculated in some way into your risk to reward ratio. It is present in trading both futures and option contracts. Another category of slippage is a sudden change of option premium due to a sudden big move of the underlying. It is a very important concept when you trade options, and it can be both positive or negative for your trading results. So let me explain you this topic through this example. It's a real trade I have taken, so I can give you very realistic numbers. I have entered the trade when I saw these sellers around point of control, together with a favorable candlestick pattern. My target and intended exit was at the second liquidity level, but due to the rapid moves, I have got filled a bit higher, so I have got about 6 to 7 points of this move. I have traded SPX put options when the delta was between 0.45 and 0.5, so the trade should pay me between $170 when you take 6 points and lower delta, and $350 when we take 7 points and 0.5 delta per contract. In reality, I have paid $930 per contract, but I have got $1,380 at the exit. So it means $450 of profit per contract. So I have got paid like for a 9 to 10 point move, for a 6 to 7 point move, due to premium expansion in the fast move. So this time this slippage was in my favor, but it works the same in the negative way. And you can imagine what would happen if you would hold calls instead of puts. This kind of slippage is a big reason why many traders love to trade options. You can make some extra money if you get it right. There is also the opposite risk. There is also another issue. Makes planning your entry and exit more complicated, as you don't know where the exact contract price will be. So if you don't like it and want more precision for your trades, then you should trade futures. In a very volatile market or during big events, the bid-ask spreads can widen by a lot when you trade options and can seriously influence your trading costs. When you trade futures, this problem is much smaller, or sometimes even non-existent. Theta decay. Another danger when you trade options is the theta decay or time decay. Even when the price stays flat, the option loses its value over time, and it is much more profound when you trade zero DTE options. But if you follow our trading techniques, then it is not much of a concern, as our trades typically last from a few minutes to half an hour, and you can also influence this risk by choosing options with higher delta if you plan a longer trade. These were the most important issues I wanted to highlight. If you have any questions, feel free to ask in the comments. If you find this video helpful, please hit the like button and subscribe. And if you really mean it with trading, you can join a free version of our Discord community, where I share more setups and education, and you can ask me to get my in-depth analysis on your trade or setup for free. I will choose 3 of your questions every week and give a public answer everyone can see and benefit from. Just click the link below in description. Thank you very much and see you next time.